I'm Kathy Svatina, and this is The Efficiency Code, your guide to unlocking peak performance in finance and procurement. Listen as we decode the strategies of top industry leaders who are redefining efficiency and optimization. From spend management to lean operations, discover how to achieve more with less. Join us as we crack the code to sustainable growth. My guest today is Billy Morris. Billy is a seasoned financial leader with over 15 years of experience driving strategic growth and financial performance. As a chartered accountant with strong background in corporate finance and financial planning and analysis, he has held senior leadership roles in high-growth tech companies across Ireland and the US. His expertise spans financial modeling, reporting, and analysis, as well as business valuation and capital raising. Billy is currently the CFO at Genesis Global, where he is using his deep financial acumen to drive innovation and growth. Welcome to the show, Billy.
Thanks, Kathy. Delighted to be here. Looking forward to chatting.
Yeah, I'm delighted as well. We're going to have such a great conversation. You know, you have such a diverse finance background and experience in both M&A and IPO, both experience that I'd really like to unpack in this episode. But first, let me ask you this. What does sustainable growth mean to you?
Good question. And I think as you think about sustainable growth in different time periods, different phases of macro or microeconomic environments, I think that sort of answer might be a little bit different. But I suppose as I've thought about what sustainable growth looks like and what it looks like now, I put myself back to when I worked in Twilio, quite a different environment back in 2014, 2015. They're Bessemer backed, and amongst some other great VCs. And I think as we dove into looking at unit economics and how we might scale the business, we looked at a bunch of different metrics and measures of success. Looking at across the likes of LTV, CAC, growth efficiency index, net dollar expansion, gross retention. ARR per employee, et cetera. And I think Bessemer, amongst, some of the other great VCs out there like Redpoint, Tamaz Tungu's, Byron Dieter from Bessemer, they provide a wealth of benchmarking reports, sort of best in class metrics to measure against what great looks like. And so I suppose as we were reviewing our business at the time, we started to look at a lot of the benchmark metrics out there. And then, where are we today? Where have we come from on a relative basis? And then where do we want to be as we scale for next fundraise or towards pre-IPO and IPO readiness? I think, as I've gone through my career working with ThousandEyes after Twilio, they were Sequoia backed, similar, fantastic support on, what great looks like. Others out there like Google Ventures and Salesforce Ventures that I've worked with, they all have fantastic input on, how to look at where you are today and how to scale. Most recently, I working with Excel, Insight, Tiger, all have some fantastic input. I think one of the key measures of success for sustainable growth is obviously balancing out growth versus cash. And obviously today we know cash is king, has been for a long time, but balancing out that ratio of new bookings to cash burn or net new ARR to cash burn, I think is a very good overall sort of high level measure, and sort of, just the concept of how much does it take in cash burn to bring in a dollar of new bookings or a dollar of new ARR, knowing that you can look at that obviously on a relative basis, but also just knowing, you probably shouldn't be spending $10 for $1 of new. You probably shouldn't be spending much more than $1. But in the early stages, obviously, it will take a little bit more to break through on some of those sort of product market fit stages. And as you jump through the next, evolution of your go-to-market strategy. But overall, I think, tapering toward the one or over one is a good measure. The other metric that I think has always shone through is net dollar expansion rate. And obviously that's the combination of both retaining existing clients or customers and then growing them. The holy grail a gross retention of over 90% and net dollar expansion of 115, 120, 125. I had the luck and pleasure of seeing that in Twilio. They had exponential growth, very strong retention, great expansion. They were a usage or consumption based model, which really helped in that exponential growth. But obviously you need to make sure that you're retaining and successfully deploying your product into the customer base, continually showing success and satisfaction over a long time. So I think that measure, a dollar of retained business is much cheaper to sustain than a dollar of new logo business. However, new logos are the lifeblood of the business, and I think that they are what drives sustainable future growth in your business. So I think capital efficiency, balancing out new business versus cash burn, net dollar expansion gives you a very good idea of how you're succeeding with your existing customer base. And then new logo acquisition, obviously there's great measures out there like cost of acquisition and LTV, etc. But knowing what you're spending to bring in a customer today, I think is absolutely critical. Obviously having a leaky bucket and lots of new clients that walk out the door in a year is never good. So I think having those sort of trifecta of measures of success, I think has always been top of mind for me. Back when I started my career, in sort of financial modeling with Deloitte and looking at some of the early measures of success, I think it was probably top line growth and EBITDA. I think as you think about a VC backed or growth oriented business, you want to look at the precursor measures of success, before you may be profitable. And I think those metrics that I mentioned, I think give you that, but obviously keeping an eye on sort of the sustainable growth is key. And I think they give you a roadmap or put them on the radar for how you're going to, sort of grow from here.
And you mentioned capital efficiency, and I want to drill down a little bit on that. When you're looking at your capital, how do you make sure that you're using it efficiently? Are there certain things that you're looking, certain metrics that you're looking for? How do you look at that?
Yeah, I think balancing out your P&L in terms of obviously COGS, sales and marketing, R&D, G&A, and then tracking back to where do we want to deploy our investment today, but also obviously in potentially a more uncertain world, tomorrow, and making your cash last. I think obviously, investing in your tech, investing in R&D is absolutely critical. And I think as you look at your prioritization of where you deploy or invest in the business, I think R&D probably has to stack rank at the start. Building out your product, building out your platform, building out your offering, probably number one. And again, depending on what stage you're investing in, I've worked in businesses from Series B all the way through to post IPO, as well as post acquisition with ThousandEyes as we were acquired by Cisco. And I think determining where you are in that growth stage or growth journey and investing or deploying capital in different proportionalities is key. Once you know that you have product market fit and you start to see the flywheel churning, through marketing and sales, I think obviously, driving the sales efficiency metrics and, again, as I mentioned, the capital efficiency, I think gives a good sense of, are you burning too much to bring in a dollar of new business? But sales efficiency metrics, obviously around looking at your sales and marketing spend compared to new bookings, looking at LTV CAC, as we talked about, CAC payback, the sort of sales rep driven ratios or measures of success like attainment or productivity per rep. Knowing that they're in the right place, I think you start to really deploy investments into sales and into marketing. But again, that probably comes after, investing in tech and investing in your product and knowing that there's product market fit. I think backing up, you also obviously have to invest in your corporate support functions and G&A, but looking at the right benchmarks out there. And I think that's what we've always leaned into, at a reasonable top line range or headcount range versus others that have successfully scaled and deployed investments. I think you want to have that on the radar, and also think about, it's very hard to even plan for a year ahead, but thinking about a 3 or 5 year horizon, when could you theoretically be looking at, a break even point or your next fundraise, and knowing what your runway is. So sort of really bringing back your investment to, I think, your capital, your cash burn and cash runway, I think really helps you drive some of that prioritization, because, there might be some nice to haves there in your product roadmap, but if you know that you need to prioritize, certain regions, certain functionality, etc., that will drive part of the prioritization process and then into your go-to-market strategy. So knowing, what great looks like and looking at some of those benchmarks and just coming back to the likes of Bessemer, Insight, Sequoia, Accel, the fantastic wealth of information out there to really lean on. And so I think, as I think about investing in Genesis, we've really, got a wealth of information from our VC portfolio investors, and helped us to think about or navigate, sort of choppy waters that we've seen in the last couple of years from a macro perspective, and making sure that we've got, sufficient runway ahead of us to see any, choppier waters still to come potentially, but also making sure we're investing in our tech and growing our go-to-market strategy.
And I got to ask, because you have such great experience in M&A that you did through the ThousandEyes when it was acquired by Cisco, and your background is in FP&A. I want to ask, how do you think FP&A has prepared you for the M&A activities that you had to go through when you did that acquisition?
Yeah, I think I came from a sort of a generalist finance background, accounting, and then found myself in corporate finance and ultimately FP&A. And I think financial modeling really was just a fundamental skill set that you needed in all, I guess, sort of corporate finance initiatives, be it fundraising or valuations or private equity work, and that helped, I guess, to really sort of jump through some of the hoops in learning or understanding a business or the drivers of a particular business, and going through so many projects on that front, I think was really helpful. I think FP&A, you tend to get involved in all sorts of different initiatives, from the most granular all the way to the most strategic very quickly. I think you become a trusted advisor to the senior, executive team, board interaction, investor interaction. And I think that gives you a very well-rounded overview of the business, knowing, the good, the bad, and the ugly within the business quite quickly. But yeah, also becoming that trusted advisor. And I think that's then sort of evolved into a holistic view of, where we're at today, and knowing where the priorities are for the future. When it comes to going through, I guess, IPO prep or fundraising prep or due diligence process, you really have to have, I think, a 10,000 foot level, but also in the weeds. And obviously working in FP&A, it's a double-edged sword, because you get access to, a wealth of information, lots of meetings, lots of conversations, lots of projects. It's a lot of work. And so I think you have to, know that as you go through that trajectory, you're learning and sort of building on your prior experience, but knowing, future career development, et cetera, gets you into, sort of future, growth opportunities. But I think, just on your question around, an M&A process and diligence, you already have been involved in a lot of those sort of board level or investor, discussions, or at least have received a lot of the follow up from that. And I think that then informs where we might need to, lean in and provide more analysis or analytics on the business. It prepares you for some of the sort of 11th hour questions or multiple rounds of additional questions. I think it prepares you for, some of those left field type questions. And I think they're all very good to have, be it, whether the diligence process, successfully finishes in an acquisition or not. I think it prepares you internally for, what's next. And I think, it's always good process to have potentially even a basic data room started, because, who knows what comes down the line. And I think, not that you want to continuously prepare or plan for an M&A exit or IPO preparedness, well in advance. But if you start early, around your tax, accounting, legal, financial diligence, all the way to your tech diligence, I think that really does force the business to be thinking about things in the future. We had done some of that, which was fantastic. It was great to have had that sort of prior art to start with. We had gone through in ThousandEyes, we had gone through a Series D financing round, which is led by Google Ventures in San Francisco. And that obviously prepared the business for the next stage of maturity, next level of diligence, next level of conversations about, both sort of financial, operational, strategic topics. I would say the process with Cisco was fantastic. It was, I think they're one of the most acquisitive tech buyers out there. I think 200 or 300 acquisitions under their belt. They know what they're looking for. They have a lot of machinery around it, but they really drive a very disciplined, rigorous process, for good reason. And I think that took us as a business, us as an FP&A team, as a finance team, as a full company to really get behind and drive forward. Obviously, we had a very successful acquisition with Cisco. And I think a lot of that sort of prior work lends into what you do up front, because it sets the scene on what's to come, your operating cadence, who the right people are to talk to and get to the right answers. And I think coming back to your original question, I think FP&A can be, sort of that centralized team to draw from the wealth of expertise and information from within the company, and then equip it in a standardized sort of delivery mechanism into the acquiring company. So we found that to be really successfully deployed, at least in that example. And I think should I ever look at that again, I think that's probably the approach that we would take.
And was there anything that surprised you as you were going through this process?
Yeah, I mean, I think we were about 400 people when we were acquired. I think Cisco was about 85,000 people. And I think the wealth of expertise from within Cisco spent so much time and effort in drilling into the nth detail with us. And I think that really helped, as I mentioned, set the scene for what was to come. And so, so many people with a focal point. We were, I think, the first acquisition that was entirely remote during COVID. And so obviously that came with challenges on both sides to make sure that we were able to get the information flowing and provide as much sort of back and forth as quickly as possible. But we did it. We went through all of that in almost an entirely remote approach. And I think it was always done in a very, good-hearted way and sort of positively received. So I think, the surprising aspect was probably just the sheer focus on us from such a massive organization. But in the end, I think it really sort of helped to succeed, to drive success on the acquisition and set a very sort of positive foundation to build off of. And then obviously all of that sort of what followed built a lot of trust and rapport and, a strong reputation post acquisition. I think there were, obviously knowing where you will sit and how budget gets determined and, if there's ring fenced budget or not, post acquisition, and knowing, where that will draw from or for what period of time. I think that was really important to to align on very early in the process, which we did. And again, I think not that that was really a surprise, but I think it really helped in the success of the acquisition, after the fact. So yeah, those would probably be my 2 points, not necessarily hugely surprising, but I think that were critical in helping to drive a successful outcome.
Yeah, I want to move into your IPO experience because I think that is such an interesting story that you also had when we were preparing for this conversation. And I want to weave this into this podcast as well. When you started working for Twilio, you were one of the first finance people there. So they had an accounting function, and then you were one of the first finance hires. And I do want to ask you, as you were building that finance function out there, what were some of the significant learnings that you had from this, I would assume, a pretty intense period of growth?
Yeah, I think when I joined Twilio, we were a small but mighty team, and I think being able to support the business, it was going through a hyper scale up journey. Very very high top line ARR growth. We grew the business operationally, obviously headcount, geographically across all functions. One of the things that really equipped us to allow for that sort of scaling was our data environment and being able to lean into all different parts of the business, but be able to quickly capture information or data. And I think when I first started, one of the initial tasks was to help bring in a BI tool. We hadn't had something in finance or FP&A before. We went through a sort of vendor selection process. We landed on, at the time, a very sort of early stage provider called Looker, and we brought that into the business in a finance capacity. That was implemented, sort of in combination with our engineering team as well as finance, and ultimately grew within the entire organization to become one of the sort of cross-functional sort of BI tools or data capture tools. Fast forwarding, going through subsequent fundraising, we went through a Series E crossover round before we IPO'd. I think having, that sort of data environment to capture all sorts of metrics, like how many customers do you have, or what's your top line ARR, or year-over-year growth, or, your GRR, as we mentioned, all those sort of critical metrics, having all of that, within a critical BI tool was obviously key, and putting it in early. I think the data team also being under the umbrella or under the CFO org was really helpful, because ultimately, product metrics, platform metrics, sales metrics, marketing metrics, they all funnel into some financial metric of some sort. And so having the data or analytics team at least being aware or overseeing some of how those metrics get defined and how they transform into a financial metric, I think was really important as we came to the likes of our business metrics within our S1 filing or developing the first drafts. Being able to stand behind all the data was obviously critical. And so I think that was a really successful area that we thankfully had built, sort of prior to even starting pre-IPO prep, helped to build the foundation for that, Series E crossover round. And then that sort of, we closed that with T Rowe and Fidelity, which was a great sort of crossover institutional round. And obviously, again, they go through a very rigorous process. So raising the bar, leaning on our internal FP&A, legal, accounting, tax, tech, sales and marketing support, all through a strong data environment enables, I think, a quicker cycle on developing all of those metrics that were critical towards that IPO. So I think that was probably one of the things that stood out for me, and I followed in that path in my journey since then in ThousandEyes and in Genesis. I think having a very strong relationship between data and analytics, FP&A, and your sort of corporate executive team, bringing everyone along in that journey, I think is really important. So that's something that I've established today, and I think I definitely recommend that as part of the finance oversight as early as you can afford to bring it in.
Yeah, and this is funny. As you were talking, I was nodding my head, because one of the things that I always say, that everything that happens in the business is eventually going to end up in finances. So
Mm.
having those data points in advance, so you can actually see what's happening and you can make decisions in advance, that is so, so important. But as you were implementing this BI tool, how was that implementation process for you? Did it take a long time? Or was it pretty fast? I'm always curious about change management with that, because that can be such a culture shock when you go from not having anything at all to now all of a sudden having all this data and trying to untangle what do we use, what do we don't use.
Yeah, I think in that example, there was a wealth of internal data, and obviously that was used, through sort of internally built functionality. I think what we hadn't had at the time was a business tool across all functions, and that's where Looker came into its own. We partnered very closely with the engineering team at the time, and then ultimately, it was a successful implementation. I think, bringing the business along, there was a lot of internal alignment, communication. I think something that I've learned over the years. I think in items like that, you can't over communicate enough, and bringing people along the journey, I think, is really important. And obviously, showing the value to your specific stakeholders, to knowing your audience, and sort of driving towards how this will help us as a business, how this will help you as a team, I think is really important. I think ultimately, founder CEO Jeff Lawson, he started to see some of the reporting on Looker, and I think he really liked the visibility, transparency of different metrics, etc. And he started to pick it up and use it across, and I think that really expedited or accelerated the adoption. So obviously getting your executive buyer, obviously, all the way from your CEO down, I think is really important. So it's probably over communication, executive buy-in, and then support from obviously your key stakeholders, I think, help to make that change management process a little bit easier.
Yep, yeah, that makes sense. And as you were going through the IPO, I'm curious, if you were grabbing coffee with a fellow CFO that is thinking about going through an IPO process, what would be some of tidbits of wisdom that you would give them?
Great question. I think starting early is probably something I would say. It's a huge amount of work across many different stakeholders, internal and external. I think, obviously going through your own internal data environment, and across every function, obviously your tech stack, risk and compliance is critical. Obviously, accounting, tax, finance, and being able to drill into the nth detail on all of those critical business metrics. And as I mentioned, I think having your data environment in a accessible and transparent system or BI tool, etc., is really important. I think then obviously, building that tiger team from within the different functions that will ultimately be probably the key point people internally, and aligning them with the right people externally, like your bankers, your external legal counsel. I think is doing that early and building that rapport and relationship is key. Again, sort of on the data environments, and making sure your systems are robust, your vendor selection, all the way through to the tiger team internally, and aligning with the right partners externally. Knowing if you have time to sort of planning for all of that would probably be a critical word of advice that I learned through my experience. I think the other one is going through, I would say, mock earnings calls and mock guidance development very, very early. And I think it's a great process for, pre any exit, for any sort of scaling growth business, for, potentially looking at, investor discussions or board meetings, having a mock earnings script, having mock earnings statements and having, CEO, CFO, IR, whomever the right people are in that stage of company to go through that, I think is really important, because once you obviously go through that process, then every quarter you have to go through this process again, and you want to make sure your earnings guidance is spot on, and you're prepared to the nth level of detail for every question that might come up. And I think we were really lucky in our sort of post IPO process. I was part of the first 4 earnings calls post IPO, and just seeing the level of detail that had to go into all of the preparation for that. So knowing what's to come, I think is probably the biggest bit of advice I would have, and preparedness. You cannot be prepared enough. So doing it early, I think, would be key.
And when you were going through this, did you have an investor relations team? And when do you think it would be appropriate to actually hire a specific investor relations team? Because when I was, I worked in large corporations before I went on my own, and a lot of that was on the shoulders of investor relations, and they were really, really crucial when it comes to earning calls and when it comes to the prep. So when do you think it's the right time to have a team like that?
Yeah. So my only experience with an IPO was with Twilio. I was there for about just under 4 years, from Series D, about 200, just over 200 people, through to a year post IPO, where we had scaled, I think, 5x in headcount and probably more than 10x in top line at the time. When I joined, I was one of the first finance hires, and we built out our sort of internal financial management, reporting, forecasting, analysis. We were consumption based, and so it was quite a complex sort of monthly and quarterly process to go through. Usage and our top line MRR and ARR. So there's a lot of analytics that went into that, and then enabled us to give us a predictable forecast on top line, and obviously everything rippled from that. So as we sort of grew the team, grew in complexity, we added into the FP&A team to really drive specific dedicated focus on ARR, revenue, obviously full P&L, OpEx, full financials. When we started to post our Series E crossover, we started to obviously drive more of our internal pre-IPO prep, and that's when we brought in our head of IR, who's a very seasoned IR professional, and had seen things on both sides of the equation, which I think was really great. And FP&A and IR partnered on all sorts of metrics development, guidance, a lot of the earnings prep, all the way through to obviously the business metrics and S1 drafting. So I think that partnership between finance and IR was very, very strong. We brought in IR later than we built the finance team, so there was a foundation obviously to lean into for the IR function. But the IR function was brought in probably a year, maybe year and a bit pre IPO to really help in that ramp. And then obviously that team grew and took over all of the investor relations, partnering with all of our sort of bankers, et cetera, post IPO. I think, sometime probably in that year before, maybe year and a bit, to establish again that internal relationship. But obviously, there's a lot of external facing work that needs to be done even before you start to develop your S1. So I think having someone in a little bit before to give them a chance to get their feet under the table is probably really important.
Yeah, that makes a lot of sense. Billy, this was a fabulous conversation that we had. I learned so much from you. My last question here is, what is your number one tip for finance leaders when it comes to tackling a rising SaaS and cloud costs?
Yeah, no, great question. Obviously very apt at the moment. I think every, growth business is obviously having to do more with less and grow our top line, but with a very keen eye on cost and cash burn in particular. I think we go through, as part of our annual budgeting cycle, we go through, bottoms up sort of zero budgeting type approach, but look at it with a lens on, all vendor spend, all software spend, obviously categorized into business or mission critical systems, nice to haves and need to haves, and obviously sort of need to have a review and a business case for why a particular system might be needed, or if a new business system needs to be implemented. I think looking at obviously automation and AI, I think there's a lot of gains to be made, in the finance world, but overall in how can we automate and do more for less. And I think that is only more important today. So baking that into your annual budgeting process, I think is probably, the bread and butter. But then looking at, other newer ways of systematizing or automating functions. I mean, there's a bunch in the finance world to automate and streamline and remove some of the lower level, very manual tasks. And I think being able to make the case of time saved, etc., I think is really important. So making that investment now is probably going to do, those companies best in the next 2-3 years. The other one that I think was or is very helpful, obviously, as vendor lock-in or vendor spend is probably quite top of mind. Being aware of over-reliance, having a centralized view of all company-wide business systems, I think is really important, because obviously there can be duplication or latency somewhere that you might need, and that can obviously save quite meaningful dollars. So we're in our growth mode. We have a small data and analytics team, but they oversee all critical business systems and kind of know if we could potentially lean in one or out of another. And so having a centralized oversight, I think is key. Otherwise, one department may not know what the other department is doing. I think that's a pretty straightforward one. So that's on the SaaS side. And I think the other very large sort of non-headcount expenditure that most businesses have is obviously on their hosting or cloud environments. Across every business that I've worked in, you're probably primarily aligned to one provider, and building a very strong partnership with that one provider, I think is really key, not only for cost savings, but also to leverage their mass, portfolio to more sort of commercial or strategic partnerships. And so being able to look at both sides of the coin, I think with your primary provider is key. The other one is it probably pays off to have a multi-cloud strategy and, having backup or latency, either from a security perspective or outage or mitigation or risk mitigation perspective, but also, to have optionality and sort of cost comparisons, etc., I think is also a great strategy there. So, going for a primary, building the partnership there, but also potentially having a secondary that comes with, support, maintenance, management internally, but oftentimes is well worth that investment.
Yep. Well, Billy, thank you so much for being on the podcast. It's been a pleasure having you.
Thanks so much, Kathy. Have a great day.